लास्ट वीडियो में हमने बात करी थी एन्युटीज के बारे में एंड उसके साथ रिलेटेड कुछ क्वेश्चंस को कवर किया था। आपको याद करवा देता हूँ। सो वी वर कवरिंग दिस पर्टिकुलर क्वेश्चन जिसपे हमारे पास एन्युटी ड्यू का केस था बिकॉज इट वाज रिलेटेड टू इन द बिगिनिंग ऑफ द पीरियड एंड डिस्काउंट रेट दिया गया था हमें एंड फॉर द जो कैश फ्लो का अमाउंट था वो हमें प्रोवाइड किया गया था। 5 साल का टेनर दिया गया था एंड वी वर टू कैलकुलेट द प्रेजेंट वैल्यू, राइट। अब उसी सेम क्वेश्चन में वी आर गोइंग टू कैलकुलेट द फ्यूचर वैल्यू। तो फ्यूचर वैल्यू ऑफ एन्युटी ड्यू का फॉर्मूला क्या होता है? व्हाट इज अ फॉर्मूला फॉर द सेम? आपको याद करवाया था मैंने ऑलरेडी। देखो जो सेम फॉर्मूला आपका होता है ना, फ्यूचर वैल्यू फॉर द ऑर्डिनरी एन्युटी, सेम फॉर्मूला लिख लेंगे पहले। तो इट इज कैश फ्लो दैट इज सी इंटू 1 + i, क्योंकि जब हम फ्यूचर वैल्यू की बात करते हैं तो आई आता है, नहीं तो आर आता है, राइट। रेज टू पावर n -1 डिवाइडेड बाय आई, ये फॉर्मूला था फ्यूचर वैल्यू ऑफ द ऑर्डिनरी एन्युटी का फॉर्मूला। ये वाला फॉर्मूला था, ठीक है। मैंने आपको कल भी करवाया था, उस वीडियो को गो थ्रू कर लेना। सभी 4 फॉर्मूलाज को कैसे याद करवाना किया है वो भी बताया था आपको। सो ये है सेकंड पार्ट ऑफ द वीडियो और चैनल को सब्सक्राइब कर लेना अगर चैनल को अभी तक सब्सक्राइब नहीं किया है। और साथ में क्योंकि ये एन्युटी ड्यू है तो एक टर्म एक्स्ट्रा आती है, सो इट विल बी 1 + i ओवर हियर। बस अब इसको सॉल्व करना है। सी की वैल्यू हमें दी गई है 5000 ऑलरेडी एंड आई की वैल्यू 12% है, सो इट विल बी 1.12 रेज टू पावर 5 हो जाएगा -1 डिवाइडेड बाय 0.12, क्योंकि 12% था डेसिमल में लिख दिया एंड 1.12 यहाँ पर आ जाएगा। डैट वुड बी इट। बहुत बस इतना सही। एंड इतने से ही आपका जो क्वेश्चन है वो पूरा का पूरा सॉल्व होने वाला है। मैं फटाफट से यहाँ पर कैलकुलेटर के ऊपर आपको कैलकुलेशंस करके बताता हूँ। सो इट विल बी 1.12 मल्टीप्लाइड बाय 1.12। अब जितना रेज टू पावर है उससे एक कम टाइम इक्वल टू का साइन प्रेस करेंगे। सो इट विल बी, इट वाज रेज टू पावर 5, तो हम वी विल बी प्रेसिंग द इक्वल टू साइन फॉर 4 टाइम्स, राइट। सो 1 2 3 4, so it is 1.7623, right? So it is 1.7623 minus 1 and divided by 0.12 and further multiplied by 1.12 and further multiplied by 5000, right? So the amount is 35575. So answer over here will be 35575, right? So this is the future value that we calculated, right? Now let's move to the other topic. Now it's related to the bullet or the balloon repayment. That what is bullet payment and what is the balloon repayment, right? So under this particular case, the entire loan amount is actually paid at the end of the period. Have you ever noticed the case of the bonds? Let's say case company is here, XYZ company is here, and it issued the bonds, right? Bond is a debt instrument. We covered in the last video also, right? Now in the case of the debt instruments, what is to be done? That the coupon is paid. Coupon is paid each and every year, right? Coupon is paid. Let's say case the bond is having the maturity for 3 years, right? So it will be 0 1 2 3 and so rupees 1000 coupon with 8% of the coupon rate, right? 1000 bond with 8% of the coupon rate over there. So 80 rupees were paid for each and every year, right? And no principal payment is done so far. So principal amount will be paid at the end of the tenor, right? So 1000 rupees will be paid at the end of the tenor, right? So now in this particular scenario, this is actually related to what type of repayment? This is showcasing the bullet repayment. This is showcasing the bullet repayment, right? So actually what is happening? We are going to pay the entire loan amount. We are going to repay the entire loan amount at the end of the tenor. At the end of the tenor, end of the period. This is called what? This is called the bullet repayment. Now it may be the case that we are going to pay the whole amount in the end. We are going to pay the whole amount. That interest is paid like year over year, or it may also be the case that the interest is to be paid at the end of the period, right? Now if it is to be paid at the end of the tenor, in that scenario we can easily be calculating the amount of interest by applying the compounding interest formula, right? And if the interest is to be paid periodically, so it will be paid when it is applied, and the last installment will be equivalent to what? It will be equivalent to loan amount, right? And also the interest for the last period, like which happens in the case of the bond here, right? That is the case. Now after that, it's the example related to sinking fund. Now sinking fund is a perfect example that how we want to repay the bullet payment. All right, now let's say case person Ramesh is here and he want to purchase a car 7 years from now. So it is 0, 1, 2, 3 and 7, right? He want to purchase a car 7 years from now and he want to purchase car amounting 30 lakh rupees, right? So he want to get a balance of rupees 30 lakh rupees at the end of the tenure, and he is right now able to invest the money per year at 10% per annum. So now whatsoever the amount he will be investing, he's supposing that he'll be getting 10% of the returns, right? So he's actually very much enthusiast so as to know that what amount he should be depositing each and every year so that he will be getting the amount of rupees 30 lakh at the end of the period 7 years. Okay, now this 30 lakh is actually representing what? This is representing the future value or present value? Clearly this is indicating the future value, right? And for the, let's say he wants to deposit the money in the end of the period, so what type of annuity it will be? It will be the case of the ordinary annuity, because ordinary annuity is associated with the end of the tenor, right? So it will be the case of the ordinary annuity, right? So he'll be depositing money here, here and so on. Okay, so if we apply the formula of the future value of the annuity of the ordinary annuity, what is the formula? The formula is C into 1 plus I raised to power n minus 1 divided by I. This is the formula. Now future value we are already having, that is amounting 30 lakh, right? C is what we need to calculate, and we are considering the I to be 10%. So it is 1.10 raised to power 7 minus 1 divided by 0.10, right? This is the scenario. So now we can easily be calculating. So you can also be opening your simple calculator so as to calculate. So 1.1 multiplied by 1.1, and then we will be pressing equal to sign for 6 times. So 1, 2, 3, 4, 5, 6, 1.94 something minus 1 and divided by 0.1. So the whole particular this bracket is equal to 9.4871. So it is 30 lakh divided by 9.4871. So it is the amount coming out to be 3,16,218. So the person will be depositing rupees 3,16,218 at the end of the year for 7 years. Then he will be having the sum amount equal to 30 lakh at the end of 7 years, right? So that is how we're going to use. And this concept is said to be what? This is said to be the sinking fund. This concept is used in the case of depreciation. This concept is used by the companies when they are to make the bullet payments, right? So this is a scenario, right? So sinking fund is kind of fund in which a fixed amount is to be deposited at a regular interval, right? So that is a scenario. Now let's solve a question based upon it. We are going for this particular question also. So it says, if you wish annuity to grow to 10 lakh rupees over 5 years so that you can replace your car, what monthly deposit would be required if you could invest at 8% annually, right? Now we are considering two things. First of all, we want the value at the end of 5 years. What value? We want it to be 10 lakh. So if we draw the timeline 0, 1, 2, 3, 4 and 5. At the end of 5 years, we want the value of 10 lakh. We want the value of 10 lakh, right? That is the case. We want to replace the car. What monthly deposit? We are not considering the yearly deposit. We are considering about the monthly deposit over here. Kindly pay attention, right? Now we are to make the monthly deposits. Okay. So now here the rate is given to be 8% per annum. First of all, we will be converting this 8% to monthly basis. So it will be 8 divided by 100 and further divided by 12, right? So that will be the formula. That is a rate that will be applicable. So it will be 8 divided by 12 and divided by 100. So it is coming out to be 0.0067. So this would be the rate per month. This is per month rate which will be applicable. And if we talk about the tenor is given to be 5 years, but it is to be in months. So it will be 5 into 12. That is 60 months. We are to make the deposits for the 60 months here, right? And we are not clear that the person is going to deposit the amount at the end of the tenor or in the beginning of the period. I mean, when the question is silent, about the when the amount will be deposited or when the amount will not be, right? In that scenario, we will be considering the case of the ordinary annuity, right? Now, we will be considering the case of the ordinary annuity. So what value we are having right now with hand? We are having the future value. So we'll be applying the future value of the ordinary annuity formula. Future value of the ordinary annuity formula, C into 1 plus I raised to power n minus 1 divided by I. This is the formula. We are having the value over here equal to 10 lakh. And C is the value we need to calculate. 1 plus I, that is 1.0067, and raised to power 60 minus 1 divided by 0.0067. This is what we need to calculate. Now, you will be finding it difficult because if we apply the old method so as to calculate the value on the simple calculator, we have to press the equal to sign for 59 times. Definitely we can make a mistake in that, right? So we will be making the factors of the same. So we can be rewriting this particular term as 0.0067 raised to power 6 and raised to power 10. This is how we need to calculate. So first of all, we will be calculating the inner bracket, that is 0.0067 multiplied by 0.0067. Now raised to power 6 means we will be pressing the equal to sign for the 5 times. So 1, 2, 3, 4, 5. That is the case, right? So it is something very much, a weird thing, that answer that you will be getting over here, right? So it will be, first of all, we calculated the inner bracket. So it came out to be 1.04087994 and raised to power 10 now. Now multiplying it with the same value, that is 1.04087994, and now we'll be pressing the equal to sign for 9 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So it came out to be 1.49, right? So we basically calculated the value and it came out to be, the complete value came out to be 1.49. Right, so I'll be rubbing these values because that was just so as to showcase you. So now we know that it is equal to C into 1.49 minus 1 divided by 0.0067. So we'll be solving it, minus 1 and further divided by 0.0067, and that is 73.5535. Okay, so it will be 10 lakh divided by 73.55. So it is almost 13,596 rupees. So if you are investing money at 8% and for 8% per annum for monthly basis, then you need to deposit almost 13,596 rupees every month for 5 years so as to accumulate a total amount of rupees 10 lakh. Okay, is this clear to you? So this is how we can be solving the questions. Now let's focus on the other question. It says an annuity consists of monthly repayments of rupees 600 made over 10 years. So annuity consists of monthly repayments. So we are making monthly repayments of rupees 600 over 10 years. What is the present value of the annuity? We want to calculate the present value of the annuity, and we have to consider the rate of interest of 12% per annum. So first of all, we are concerned about the present value. Now it's not clear that when we are depositing, so we'll be considering the case of the ordinary annuity, right? So it is C into 1 plus R now, because it is a case of the present value. So 1 plus R raised to power n minus 1 divided by R, and for the present value there is another extra term in the denominator also, raised to power n again, and that is it. Now we know the values already. C is equal to 600 rupees because we are depositing 600 rupees every month. And how long we have deposited the money? For over 10 years. So it will be n would be equal to what? N would be equal to 10 into 12, that is equal to 120, right? And R would be equal to what? R is given to be 12%, so it is 12 divided by 12, that is equal to 1% per annum, right? So it is 1.01, because it is 1% divided by 100, so 1.01 raised to power 120 minus 1 divided by 0.01 and further 1.01 raised to power 120. Now the main thing over here is related to calculating the value of 1.01 raised to power 120. How you will be doing so? Factorizing the same. So we can be rewriting it as 1.01 raised to power 10 and further raised to power 12. That is it. So we will be solving first of all 1.01 raised to power 10, right? So it is 1.01. So it is, I'm just solving it for you over here. So it is 1.01 multiplied by 1.01 and now pressing the equal to sign for 9 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So it is 1.104622. So it is, I'm writing over here 1.104622. 1.104622 raised to power 12. Right? Now we will be solving the same. Multiply sign. So 1.104622 and now I'll be pressing the equal to sign for 11 times because it was raised to about 12, right? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So it is 3.3. So the value we calculated to be 3.3. So this is equivalent to 3.3. Alright. So we'll be substituting the value. So we can be rewriting it as 600 multiplied by 3.3 minus 1 divided by 0.01 multiplied by 3.3. That is it. Now it's easier to solve. So 3.3 minus 1, that is equal to 2.3 divided by 0.01 and divided by 3.3, that is 69.69 multiplied by 600 and it is coming out to be 41,818, right? It is 41,818. So if I'm depositing per month 600 rupees at the rate of 12% per annum for the 5 long years, the present value would be equal to 41,000. And what total amount we have paid? It is 12 into 5. So what total amount we have paid over the 5 years? 600 multiplied by 12 multiplied by 5. So 36,000 we paid in total. So 36,000 we paid in total over the 5 years and the present value is 41,818 over here. Right? This is a present value. And also in the second question it says we are also to calculate the future value of the payments. Now for calculating the future value, it's very much easy. What will be the future value? Let's just write the formula for it. So the future value of the ordinary annuity is equal to C into 1 plus I raised to power n minus 1 divided by I. That's it. Now C is 600. We have already calculated the value for 1.01 raised to power 120 over here, minus 1 divided by 1 point, it is 0.01 over here, 0.01, and that's it. If we calculate the future value, it is 3.3 minus 1 and further divided by 0.01 multiplied by 600. The future value came out to be 1,38,000. The future value is 1,38,000. Is that clear? So the future value came out to be 1,38,000, but if we calculate the present value, it was reduced to 41,818 here. Alright. So this is the case. Okay. And also we may be able to solve the EMI questions also. I basically jumped that particular topic yesterday, but definitely we can be solving the EMI questions also using the same methodology. Now EMI is actually related to what? The amount that we need to pay every month. Like when we took a loan, we need to pay some amount. We can easily be solving the EMI questions also. This question is related to EMI, equated monthly installment. This is not equal monthly installment. This is equated monthly installment. Okay. Now, if I tell you that we learned four formulas from the one formula, right? If you remember, we actually learned four formulas from one particular formula that was related to future value of the ordinary annuity formula. And if I say that the present value of ordinary annuity formula is same as the equated monthly formula. So what was the present value formula? So the present value of ordinary annuity formula, if you remember, it is C into 1 plus R raised to power n minus 1 divided by R into 1 plus R raised to power n, right? Now, if you pay attention, if we pay attention to what the EMI, what is the case of EMI? We pay monthly installments, right? So this is 0, 1, 2, 3. So we pay installment at the end of the tenor. So it's a case of the ordinary annuity first of all, right? In the case of EMI, and same amount is to be paid. So it's forming an annuity. So whatsoever the cash flow we pay, it's basically C is showcasing what? C is showcasing the amount of EMI. So here also the PVOA is a loan amount. So this value that we are paid right now by the bank disburses us this value. So this is a loan amount that is given to it. So this is the loan amount. And C is indicating the EMI. And rest all you already know. That is 1 plus R raised to power n minus 1 divided by R into 1 plus R raised to power n. That's it. Right? So using the same formula, you can be solving the question for the EMI. Now let's solve a question based upon the same. Let's pay attention to what the question it says. For a loan amounting rupees 1 lakh at the interest of 12% per annum to be repaid over the period of 2 years, we need to calculate the EMI. So over here, n is equal to 2, but monthly payment is to be made, so it will be multiplied by 12, so it is 24. And if we pay attention to what the R, it is given to be 12% divided by 12, so it is 1% monthly basis, right? Now I'll be just filling in the values over here. The loan amount is rupees 1 lakh, so PV value is 1 lakh over here, and C is representing the EMI that we need to calculate, and it is 1.01 because R is 1%, so it is 1.01 raised to power 24 and for the minus 1 divided by 0.01 and again 1.01 raised to power 24. Now you already know that how to solve these particular things, factorizing the same 1.01 raised to power 6 and further raised to power 4. That is how we can be solving 1.01 raised to power 24. So 1.01 multiplied by 1.01 and pressing the equal to sign for 5 times. 1, 2, 3, 4, 5. So it is 1.06. 1.06 raised to power 4. So multiplied by 1.06 and 5. And now pressing the time equal to sign for 3 times. 1, 2, 3. So it is 1.2697. Right? Minus 1 divided by 0.01 and further divided by 1.2697, and it came out to be the whole bracket here. This whole bracket we calculated. The value is coming out to be 21.24. Right? So it is 1 lakh divided by 21.24. Answer came out to be 4,708. So this will be the EMI. This will be the EMI that the person needs to pay for each and every month for the 2 years so as to repay the loan amount of 1 lakh rupees. With the 12% of the rate of interest being charged. Right? So other than that, we are having the topic related to the equal monthly installment. Now, there are two cases. First of all, the debt can be repaid in the form of the EMI that we just knew that in that particular case, the loan amount that we are going to repay every month remains the same. EMI remains the same, right? And the other one, it's the equal monthly installment. Now, equal monthly installment is the another case. Okay. Now, what do you mean by equal monthly installment? Just let's have a look at the particular balance over here. Right? And let's pay attention toward this particular example. So our friend has borrowed rupees 1,000 from you and wants to repay you on monthly basis rather than the whole amount at all once at the end of the year. The important point here is he will be owing you less in principal each and every month. The applicable rate of interest is 8%. So the applicable rate is 0.667% every month, right? So that is the scenario. And he will be paying a regular principal amount to you every particular month, and he wants to repay you over the end of the year for one particular year. So it will be equal to what? It will be equivalent to 1000. So how many installments will be there? There will be 12 installments, I guess. Okay. But in case of equal monthly installment, the same principal amount is to be paid every year, every month, right? So it will be 1000 divided by 12. That is coming out to be 83.33. So same principal amount is to be paid. So principal amount which will be paid every year, that will remain same. You can look over here. This is the first, second, third installment, fourth installment, and so on. And the principal amount will be reducing. Principal amount is reducing in the same manner, right? So we are reducing 83.33 every year. So we just subtracted this and this came, and we subtracted this and this came, and so on, right? And how the interest will be charged? Interest will be charged at 0.667% for every month. This particular interest, 0.667% interest will be charged on the principal amount remaining. So the first month it will be charged as this, and for second month it will be charged at 0.667% of 916.67. It basically amounted to this one, right? So this is how it is done. Now you can look at the factor. The amount of installment that is to be paid every month does not remain the same. It is coming different, right? Because interest is being charged on the reduced amount only. But in the case of EMI, the amount is equated. That fixed amount is to be repaid every particular month, right? So that is the difference between the equal monthly installment and the equated monthly installment. Okay. So you need not to cram. Do not cram this formula. Just memorize the particular formulas I told you, right? And you can easily be solving the questions from the same. Now let's solve some questions based upon it, and you'll be able to answer those things. So now this question is solved, but I want you to basically solve it at your end also. So X borrowed an amount of rupees 10,000 from the bank for 1 year, payable in equated monthly basis. Now what formula will be used? The present value ordinary annuity formula will be used. I'm just writing the formula. You have to solve and particularly confirm if this is right or wrong, right? So it is 1 plus r raised to power n minus 1 divided by r into 1 plus r raised to power n. That is it. So this is a present value formula that will be used. And now let's move to the another question. So it says A opened a recurring account. So over here the question says A opened a recurring account with the bank to deposit rupees 16,000 by the end of each year, right? So rupees 16,000 to be basically deposited at the end of each year, and how much amount he will get at the end of third year. So here is the scenario: 0, 1, 2, 3, and the person is depositing fixed amount at the end of each year, 16k, 16k, 16k. Now we are saying at the end of the each year, it means it's a case of the ordinary annuity, and we are concerned about calculating the value the person will be getting at the end of the tenor. Means we are concerned about the future value. So the future value of ordinary annuity is equal to C into 1 plus I raised to power n minus 1 divided by I, right? So future value we need to calculate. Amount the person is depositing rupees 16,000, and interest is given to be 10%. Now kindly do remember, here no monthly deposit is being made, yearly deposit is being made. So I will be the 10% only. So 1.10 raised to power 3 minus 1 and 0.10. That is it. That we need to solve. So 1.1 multiplied by 1.1 and raised to power 3. So we'll be pressing equal to sign for 2 times, and minus 1 and divide by 0.1 and multiplied by 16,000. It came out to be 52960. Right? So answer is 52960. Okay. Now let's move to the another question. We are having the, now let's prove this particular question also. So X wants to receive 40,000 rupees per annum for 20 years. The answer is already highlighted, but we need to know how we calculated it, right? So X wants to receive rupees 40,000 per annum for 20 years. So here is the scenario. Here is a scenario, person X is here, and here is a timeline 0, 1, 2, 3, 4, and so on, right? So the person wants to receive rupees 20,000 every year, right? By investing at 5%. So we want to invest some money 5% right now. We don't know how much amount to be invested, but we want to receive rupees 20,000 every year for 20 years, up to 20, right? So we do know the value of C, that is a cash flow. We do know the value of I, that is a interest value over here, we can say. And further, we want to know the today value that we need to invest today, on which we will be getting the value. So particularly, it's the case of the calculating the present value. It's the case of present value, that what value we should be investing right now. So it's a present value, and it is not clear in the question. It's related to ordinary annuity or annuity due. So we'll be considering the case of the ordinary annuity. So present value of ordinary annuity is equal to what? It is C into 1 plus 1 plus R raised to power n minus 1 divided by R into 1 plus R raised to power n. We need to solve this. Present value we are interested into calculating, and what amount we want to receive every year, it is 20,000 rupees, right? And for the R value is given to be 5%, so it is 1.05 raised to power 20 minus 1 divided by 0.05, and for the 1.05 raised to power 20, right? So we need to solve this. So 1.05 multiplied by 1.05, so we can be making the factors like 1.05 raised to power 4 and raised to power 5. So it came out to be, we just solved the things, and it came out to be 2.65, right? So it is 2.65 minus 1 and divide by 0.05 divide by 2.65 again multiplied by 20,000, right? And this is how you can be solving the values. So just do let me know in the comment section that what answer did you get. Okay, so the calculation is quite easier, but I think we made a mistake over here. It should be 40,000, not 20,000 over here, right? Because the cash flow we want to receive is 40,000 rupees, right? So it will be 2.65 minus 1 and divide by 0.05 and divide by 2.65 again multiplied by 40,000. So it's 4,98,113. So this one is a closest one. This one is a closest answer. So that will be the right answer. Okay. So I hope that you must have learned the concept from this video, and you must definitely have learned the things. So if you found this video useful, do give this video a thumbs up. And if you want to get the PDFs of all the videos, and further you want to get all the classes, you need to WhatsApp us writing JAIIB on the number 8360944207. Just WhatsApp me on the number, and I will be getting you all the updates. So thank you so much, and see you again in the next video. Happy learning.